Oil trading above $100 and record AI earnings are pulling equities in opposite directions right now. This is vTalkInsight, Equity Pulse Daily for May 4th, 2026, where we connect that macro tension to what is really moving stocks beneath the index level. Let's start with the energy shock and why it has become the new anchor for equity risk. The equity backdrop is now built around a very large and very specific supply shock in oil. The Strait of Hormuz remains effectively closed under a double blockade, with the United States squeezing Iranian exports and Iran restricting commercial shipping. That combination has taken more than 10 million barrels per day out of the market, with only around 6 to 6.5 million still moving through alternative pipelines, and it has pushed crude above $100 after a 25% jump in just 2 weeks. So far, the full price impact has been cushioned by drawing down inventories and strategic reserves, which is why some observers still describe the spot move as muted relative to the scale of disruption. But the longer the strait stays shut, the more acute the pressure becomes as those buffers deplete, and scenarios of a scramble for barrels with nonlinear price spikes toward $150 or even $200 per barrel move from tail risks into something the market has to contemplate. If we get into that price range and stay there, the focus shifts from risk premia to outright demand destruction, especially in Asia and Europe, where import dependence is highest. Several insights flag that sustained closure could force prices significantly higher until demand in those regions breaks, with particular concern that Asia and parts of Europe would bear the brunt of the adjustment. In the United States, the pain is showing up most clearly in gasoline, which is hitting states with higher household fuel spending the hardest, many of them traditional Republican regions. That squeezes discretionary consumption and also introduces a political layer, with commentary already linking higher pump prices to potential fallout ahead of midterm elections, adding another source of uncertainty for domestically focused equities. The geopolitical calculus suggests this risk premium may not fade quickly. Iran retains effective control over the strait, has strengthened ties with Russia and China, and appears less vulnerable to U.S. pressure than in the past, while U.S. intelligence on Iran's internal dynamics is seen as limited. Washington looks willing to accept a largely symbolic nuclear concession to exit the standoff, but both sides still think they hold the upper hand, so a clean diplomatic breakthrough in the near term is described as unlikely. Even in a more constructive scenario, where diplomacy suddenly improves and the strait reopens, energy executives like those at ExxonMobil expect it would take 1 to 2 months for physical flows to normalize and another month for crude to reach end markets. That lag means the equity market has to treat the current oil shock as a multi-quarter factor, not a headline that disappears with a single photo opportunity, and it sets the stage for the rates and inflation debate. The oil disruption is feeding straight into inflation indicators and forcing central banks into a difficult trade-off between price stability and growth. Headline inflation is reaccelerating as energy costs rise, and the ISM Manufacturing Prices Paid Index has jumped to the mid-80s, signaling the strongest input cost pressures in years. In Europe, the European Central Bank is signaling that rate hikes are back on the table as soon as June, even though recent purchasing manager surveys and lending data show growth already under strain from the war and the energy shock. Several voices warn that the ECB looks more likely than the Bank of England or the Federal Reserve to tighten into weakness, raising the risk of a policy error for Eurozone equities. The Federal Reserve picture is more finely balanced. The last meeting featured multiple unexpected dissents and came close to dropping the existing easing bias, reflecting discomfort with energy-driven inflation but also recognition of rising recession risks. Some scenarios still allow for a rate cut by year-end, but only if the conflict cools quickly and long-term inflation expectations remain anchored. Otherwise, persistently high oil risks leaking into core inflation and keeping policy tighter for longer. On the growth side, data now show weakening activity in both Europe and the United States, with real consumer spending in the U.S. slipping slightly as inflation erodes purchasing power and the savings rate falls to its lowest level since late 2022. Stresses are also emerging in private credit, where a record number of borrowers defaulted in the first quarter and spreads have widened by 50 to 75 basis points, even as some allocators see better value in more secured, asset-backed lending. Pulling this together, the stated probability of recession sits around 30%, higher than normal but still below a hard landing base case, yet stagflation risk is clearly elevated with weaker growth colliding with higher prices. For equities, that puts a spotlight on global yields near critical levels, central bank rhetoric around any decisive break above 5% in benchmark rates, and how quickly energy and input costs filter into earnings guidance. Set against this macro noise, corporate performance in the United States looks remarkably strong, and that strength is still anchoring equity indices. U.S. equities have just logged their best monthly performance since 2020, and volatility gauges like the VIX are sitting in the high teens, suggesting that despite the energy and geopolitical narrative, markets are not yet pricing a severe shock. The backbone of that resilience is earnings. Around 81% of reporting companies are beating estimates, only about 12% are missing, and a striking 88% are beating by 10 to 15%. For the S&P 500, first quarter earnings growth near 29% is running far above the roughly 14% that was expected, and full-year growth forecasts have been revised up toward the high teens to around 20%. Within that, technology and semiconductors are doing much of the heavy lifting, with tech sector earnings growth reportedly in the 40% range and global semiconductor profits up roughly tenfold over the past decade, much of it in just the last 12 months. Semiconductor stocks surged about 38% in April alone, underscoring how central the chip complex has become to both earnings and market leadership. The driver is an enormous wave of AI-related capital expenditure and demand for compute. Major tech firms are expected to spend around $700 billion on AI infrastructure this year. AI-related corporate bond issuance has reached roughly $400 billion since mid-2025, and analysts see about $4.5 trillion of hyperscaler capex between 2025 and 2030, backed by a $1.5 trillion backlog of contracted cloud revenues. However, this is not a broad-based boom. Leadership remains narrow and concentrated in technology, software, and cyclical growth, with the median S&P stock still about 13% below its high. The AI trade itself is evolving from a simple momentum story into one of dispersion, where infrastructure providers and hyperscalers are favored, while some software names and disrupted business models lag. Recent moves illustrate that high bar for execution. Atlassian rallied more than 20% after better-than-expected cloud results alleviated fears of AI disruption, while Roblox dropped over 20% after cutting its bookings outlook as new safety features dented engagement. Options markets are increasingly using both sector exchange-traded funds and single names like NVIDIA, Broadcom, and AMD to express views around this earnings season, reinforcing an environment where strong fundamentals can still win, but idiosyncratic risk is high. Overall, the story many strategists tell is that equities are migrating from a flow-driven rally toward one that stands or falls on earnings delivery. Momentum in the indices has already cooled as investors turn more neutral in light of Hormuz risks, so the sustainability of this cycle will likely depend on whether robust earnings and AI-driven margin expansion can keep offsetting energy, rates, and geopolitical headwinds. Moving down to the sector and company level, energy is the most obvious winner from the current shock, but the message from the oil majors is nuanced. Chevron and ExxonMobil have both posted significant earnings beats, helped by higher crude prices and strong U.S. operations, yet management teams are still emphasizing capital discipline and shareholder returns over aggressive production growth, even with prices elevated. Chevron's record U.S. production, limited Middle East exposure of less than 5%, and potential to increase buybacks give it relatively low direct risk to regional disruptions. ExxonMobil, by contrast, reports about 20% of its production affected by the conflict, but notes that only 3% of its facilities are impacted. It has redeployed around 13 million barrels through its trading network and expects it will take several months for volumes and shipping flows to normalize once the strait reopens. In megacap tech, Apple is a key micro-signal. The company has announced an additional $100 billion share buyback and is stepping away from its net cash neutral stance, while guiding next quarter revenue growth of roughly 14 to 17% versus consensus, near 9%. Robust gross margin guidance, strong iPhone 17 demand, and a services business now above $100 billion in annual revenue, alongside a 34% jump in R&D and an emerging AI strategy built partly on partnerships such as Google Gemini, all point to considerable pricing power, even as memory chip costs rise and Mac shortages persist. Financials show a sharp divide between regions. U.S. banks have delivered strong trading profits, particularly in commodities and deal activity, fueling expectations for sizable share buybacks once regulators settle capital requirements. In contrast, European names like NatWest are beating on earnings and even raising guidance, yet share prices are under pressure, and the banking sector is a visible drag on the FTSE 100, reflecting ongoing worries about the UK mortgage market and the broader European growth outlook. Consumer and healthcare results underline the theme of dispersion. Clorox has cut its 2026 outlook, citing weaker sentiment and rising energy costs, while Diageo is rallying on prospects of U.S. tariff relief for UK whiskey, a key revenue driver. On the healthcare and quality growth side, Moderna's pipeline is expanding beyond infectious diseases toward flu plus COVID combinations, oncology, and rare genetic conditions. Illumina is reporting 20% clinical growth in sequencing, and Berkshire Hathaway is delivering strong operating earnings, even as higher energy costs immediately squeeze margins in its chemical businesses. Real assets and materials also offer important clues about the next phase of this cycle. First Solar has beaten expectations and is investing $5 billion to expand U.S. manufacturing, helped by rising demand from data centers, including Google's acquisition of Intersect Power to secure 8 gigawatts of solar for Texas operations. In parallel, the U.S. is building a domestic rare earths value chain through moves such as USA Rare Earths' acquisition of Brazil's Serra Verde mine. Aluminum markets are facing their largest deficit since 2000, and copper supply is at risk from sulfur shortages, all of which tie the energy transition and AI infrastructure boom to tight physical commodity markets. Finally, real estate and industrials round out the picture. Tanger is reporting record leasing and raised guidance on the back of strong tenant demand and increased Gen Z foot traffic, suggesting pockets of resilient discretionary spend, while Morgan Stanley has upgraded its outlook for Caterpillar on the back of underestimated construction demand and data center growth. Even in private markets, appetite for AI exposure remains strong, with Cerebras, a private AI chipmaker, preparing an IPO at a roughly $4 billion valuation despite carrying about $40 billion in debt, highlighting both enthusiasm for the theme and the leverage risk embedded in some of the capital structure. Bringing it all together, equity markets are caught between a powerful earnings and AI story on one side and a severe, policy-driven oil shock on the other. Central banks are reacting to energy rather than controlling it. Growth is softening but not collapsing, and yet U.S. profit delivery, especially in technology and semiconductors, remains exceptional even as leadership narrows and dispersion across sectors and single names intensifies. The balance of risks now hinges on the path of the Strait of Hormuz, the reaction of the ECB and the Fed as inflation data roll in, and whether upcoming earnings from AI leaders, energy majors, banks, and global consumer franchises can keep offsetting higher input costs and tighter financial conditions. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.